By 2019, WeWork had expanded to 890 locations across 111 countries, securing a massive $47 billion private market valuation. Then, the entire structure crashed. To sell shares to the public, the company had to file an IPO prospectus. For the first time, independent accountants and regulators were allowed to verify their internal numbers. The filings revealed that WeWork did not sell software, nor did they own a proprietary digital network. They rented physical office space, added modern furniture, and subleased it. It was a traditional real estate operation. When an operation generating physical, low-margin revenues is priced by investors as an infinitely scalable tech platform, the math eventually forces a catastrophic correction. WeWork signed commercial leases with corporate landlords, locking into rigid payment obligations for 15 years. They subleased that space on flexible month-to-month terms. This duration mismatch, borrowing long, lending short, meant any occupancy dip threatened their ability to pay rent. To attract a constant flow of short-term tenants, WeWork spent heavily on physical perks like free beer, baristas, and custom design. By 2018, these operating expenses caused them to burn through $500 million in cash. Deploying aggressive, high-growth startup capital to fund a low-margin, high-risk property management model mathematically guarantees extreme financial distress. The man in this photo is Masayoshi Son, CEO of Softbank. He acted as WeWork's primary backer, heavily prioritizing aggressive expansion over short-term profitability. This flowchart maps the venture capital strategy applied to the company. Softbank injected nearly $10 billion into WeWork, and that capital had a singular directive: force immediate global expansion. Continuing through the cycle, every new country WeWork entered generated press coverage. That media narrative of rapid scaling was then used by early investors to justify an even higher private valuation, completely bypassing the need to show actual operational profit. Perpetual geographic expansion creates a smokescreen, allowing founders and early backers to obscure deep financial bleeding from the broader public. This is WeWork co-founder and CEO Adam Neumann. He utilized this lack of investor oversight to engage in an aggressive, perfectly legal strategy of self-dealing. Neumann personally purchased commercial real estate properties. He then leased those exact buildings back to WeWork at a substantial markup, extracting company funds to enrich himself. Looking at this $60 million Gulfstream private jet, we see the scale of his vanity spending. He purchased this aircraft with company money and separately charged WeWork $5.9 million simply for the right to use the trademarked word, we. When venture capital boards fail to implement corporate governance, a founder can legally extract vast sums of personal wealth, while their underlying business hemorrhages cash. In August 2019, WeWork filed its S-1 IPO registration. This legal document finally forced the company's internal accounting out into public view. This ledger visualizes the damage. The filing exposed $1.8 billion in annual losses. To obscure this, WeWork invented a meaningless accounting metric called community-adjusted EBITDA, a modified earnings calculation that conveniently ignored major operational expenses, like rent and marketing. Zooming out reveals an even starker reality. The document disclosed $47.2 billion in fixed future lease liabilities owed to commercial landlords, severely outweighing their short-term revenue commitments. When the public market compared a $47 billion valuation against extreme structural deficits, the IPO instantly collapsed. The company's private valuation evaporated in a matter of weeks. Following the failed IPO, thousands of regular WeWork employees lost their jobs, and retail investors who believed the tech narrative saw their shares become nearly worthless. Adam Neumann experienced a different outcome. He walked away with $1.2 billion from selling shares prior to the IPO attempt, and later negotiated an additional $445 million exit package from Softbank simply to step down. Neumann did not commit a crime, nor did he invent this model. He executed the modern venture capital playbook with perfect precision. As long as the investment ecosystem prioritizes rapid scaling narratives over demonstrable profit margins, the market will continue to fund companies that burn billions of dollars while following this exact same blueprint.